So one of the places that you do go when even your bank can't be trusted is gold and silver coins. So it could be that there's a rise in demand for gold and silver that cushions the effects of a recession on precious metals prices, and that gold and silver actually do just fine in the coming recession. I think it's possible. Again, we'll only know in retrospect which of these scenarios play out. So it's possible that they get smashed again, gold and silver, like in 2008 and in 2020. I don't think you should be bailing out of precious metals right now. You want to stay with your core holdings in gold and silver through everything until gold is $10,000 an ounce and silver is $200 an ounce.
In a recent interview with Liberty and Finance, financial analyst John Rubino highlighted growing concerns about the current state of the economy. Recent incidents of bank failures, including notable institutions like Silicon Valley Bank and Signature Bank, have further escalated concerns about the global financial system's stability. Rubino proposes that, in times of eroding trust in traditional banking institutions, individuals might consider alternative investment options, such as gold and silver coins. Analyst Mike Gleason, cited in an FXStreet article, echoed Rubino's concerns. He explains how such bank failures could trigger a domino effect, driving investors to seek refuge in assets like gold and silver to safeguard their wealth from the risks associated with conventional banking systems. Central bank responses following such bank collapses, such as interest rate reductions and increased money supply, could substantially impact the prices of these metals. While historical patterns see gold and silver prices drop during recessions, Rubino suggests that this time, the search for security could counteract this trend, potentially leading to price stability or even modest increases. Rubino's perspective highlights the potential dynamics at play between economic uncertainty, bank actions, and precious metal markets. Just before you watch the John Rubino's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. While acknowledging recent fluctuations in the performance of gold and silver, Rubino sees these movements as potential reactions to their ongoing struggles. Gold prices recently reached a 2-week high amid a weakening US dollar and Treasury yields, and the rally in silver prices above $24 as the US dollar faces pressure.
The impulse is that if your bank gets into trouble, or a bank similar to your bank gets into trouble, you don't want to be there when there's a run and a bailout and everything. It's just easier and simpler and more restful to take some of your money out and put it somewhere else. So the question is, where does it go? Because we're going to see stuff like that more in the Silicon Valley Bank vein going forward, where banks have to report that they're losing money in their real estate and their bond portfolios. That scares depositors who pull money out, which causes the bank to have to sell some of their bonds at a real loss in order to pay off the depositors, and then the run gets worse, et cetera, et cetera. You don't want to be involved in that. So your impulse will be to take money out of your bank. Where do you put it then? And so here's the scenario in which gold and silver do not get whacked this time in a financial crisis, because normally they go down along with stocks and real estate prices for a while, and then rocket back up when the Fed capitulates and starts easing like crazy. This time, it's possible that the money flowing out of regional and local banks flows in part into precious metals, because people are looking for safe places to put their money, and their bank is no longer safe. Your core precious metals should stay your core until this whole thing plays out and reaches its endpoint of a giant monetary reset. But with, for instance, your gold and silver mining stocks and the gold and silver coins you have that aren't part of your core portfolio, then you might want to, kind of think about how you want to play a slowing economy and a banking crisis, et cetera, et cetera. You might actually even want to buy more gold and silver in anticipation. It's just a question of which scenario you think is more likely. And I have all the gold and silver bullion that I need for this lifetime, I think. But I'm still buying really high quality miners right now, because I think some of them are just operationally so successful that they're liable to do well, or they're liable to attract a big buyout, regardless of what the overall market is like. So you can still, convince yourself that certain sectors of the precious metals market are interesting. Gold and silver have had a rough couple of months. And so this could just be a reaction against that. But it's also the case that we're heading into gold and silver's good seasonal time, which, is kind of a silly idea when you think about it. Seasonality should not affect stock prices because it's obvious. It's a thing that's right out there. And everybody could front run it, which would kind of short circuit the whole it goes up during this time of year and down during this time of year thing, but it seems to work that way for gold and silver. Yeah, that if we have an economic slowdown anytime soon here, the central banks of the world are going to have to respond to that pretty aggressively because we've taken on so much debt that even a modest recession is a potentially existential threat to a lot of over-leveraged financial entities out there. And central banks will want to get ahead of that by easing aggressively as soon as the economy drops into recession. And that's generally good for gold and silver. So it could be that people are kind of front-running the Fed's capitulation out there. Either of those, seasonality and front-running capitulation, are reasonable explanations for gold and silver going up. And we won't know what's true and what's just wishful thinking until after the fact. But right now, I think it seems like a reasonably good time to be in gold and silver and to be adding to positions in precious metals. Don't be freaked out by any of the gloom and doom that you hear from people like me, and stay with your plans, but also don't be really aggressive in any one direction because you just don't know which direction things are going to go.
Rubino warns that if interest rates increase rapidly, it could trigger a serious economic downturn. For instance, when Powell spoke at the Jackson Hole Symposium, the U.S. inflation was at 8.5%, and the Federal Reserve's key interest rate was set between 2.25% and 3%. However, by July, interest rates had surged to 5.25% to 5.5%, marking the most aggressive tightening of policy since Fed Chair Paul Volcker's actions that pushed the U.S. economy into a significant recession 40 years ago. Rubino explains that when interest rates go up quickly, it can harm the value of bonds, causing their prices to fall. Interest rates have been going up since 2022, and this trend continued in 2023. The Federal Reserve raised rates quickly, affecting the Treasury market and causing investment portfolios to lose value. Rubino highlights that this could make financial institutions report bad financial results and their stocks to drop. As a result, investors might take their money out and think about investing in options like gold and silver, which often do well when the economy is uncertain. Ole Hansen, who's in charge of making decisions about commodities at Saxo Bank, said that he thinks the pressures on the market will keep increasing because the economy is starting to feel the delayed impacts of the Federal Reserve's strong money-related decisions. Let's get back to the interview.
Financial institutions, like you said, banks, pension funds, insurance companies own a lot of bonds, and they have a lot of real estate exposure of various kinds. Those two things are interest rate sensitive. And if you have the Fed raising interest rates aggressively because they're terrified of what's going to happen if wage growth kind of spreads at 10 or 12% a year, then that's going to hurt bond prices. When interest rates go up, that's the same thing as saying bond prices go down. So the bonds on the portfolios of financial institutions develop embedded capital losses, which at some point have to be reported. In other words, so these big institutions have to show losses from their bond portfolios, and it makes real estate prices go down eventually when interest rates go up. So you'll see losses being reported by banks and insurance companies and pension funds, which will scare the people who have money invested with those entities and cause them to pull their money out or do other things that hurt institutions like that. And so you'll see a lot of those guys reporting bad numbers, seeing their stock prices fall, seeing money be pulled out, and you'll see runs on them in various ways. That's a recipe for a financial crisis that leads to a really dramatic recession too. We saw something like that back in the housing bubble and bust of 2005 to 2010. And that was brutal for financial institutions. You saw a lot of banks just collapse. A lot of insurance companies saw their derivatives books, of all things, blow up and had to be bailed out. So the same thing could happen this time around if interest rates go up too far, too fast from here. And if wages keep soaring like this, there's a decent chance that interest rates are going to do just that. So that's the one of the financial crisis scenarios that are out there right now, and that's a very real possibility.
Given the uncertainties in the global financial landscape, the potential impact of interest rate changes, and the recent trends in precious metal prices, are you considering alternative investment options like gold and silver to safeguard your wealth? What factors do you think will play the biggest role in shaping the future of the economy and financial markets? If you liked the video, don't forget to subscribe to our channel and tap the bell icon so you don't miss out on our upcoming content. Surprisingly, around 89% of our viewers haven't subscribed yet. We're aiming to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.